spoke about what's happening with metals, precious metals, and how they are associated with mutual funds. So today, that's exactly what we are going to talk about.
Absolutely. That's what we're going to be talking about, Sonal, because all of them have reached those all-time high levels. Whether you look at silver or you put the spotlight on gold, that's been shining. And with that, when you look at it, the funds that are growing because of this, the ETF returns that are coming in, that is also much higher, especially multi-asset allocations also. Those funds have seen a good run-up coming in. Now, to talk to us about all of this and understand, how you should be actually investing in these funds, is the time to actually start booking profits as well. We have Seemant Shukla, who's the CEO at Quantum AMC, joining in with us. Mr. Shukla, good afternoon, and thank you so much for joining with us on the show. Obviously, firstly, let's start by just talking about how investors should actually approach their mutual fund portfolios now, given that we've seen this sharp run-up that's coming in precious metals, silver ETFs, gold ETFs, the allocation that you have on that front. What should you be doing now? How should you look at rebalancing your portfolio?
So good afternoon, Vinnii and Sonal. Thanks for having me on this show. I think as a precious metal, India has a silver and gold, although palladium and platinum are not available from accessibility side. I think rally has been sharp and it was subdued for a pretty long time, be it gold or silver. And with this thing, I think one has to look for an asset allocation model. What has been the current weightage of these offering, or a ETF, or maybe on a other form of gold, but rebalancing depend on what type of level currently weightage is there in that asset allocation. If it's already crossed a certain limit as per the profile need of asset allocation, let's say thumb rule says 7 to 15%, and somebody is, because of this rally, has reached to 35-40%, a tactical call can be seen by reducing the exposure by selling off and allocating it to other asset classes. Generally, we have seen that a lot of people do not have gold or a silver as a asset allocation, at least on financial side. No doubt India is full of jewelry and gold in physical form, and so on financial side, if there's an under allocation in overall portfolio, the dips which might come due to consolidation and due to other factor can be a good chance to build up a portfolio to right side. So it depends on where you stand right now. If it's already overweight, you can do a correction, allocate to others. If underweight, dips would be a good opportunity to buy it and do it as strategic allocation.
Okay, so dips would be a good strategy right now. So say somebody has already gained significantly, they are seeing good gains from silver and gold funds. So do you think there are some risk of holding on versus booking profits and reallocating to other asset classes? That is the biggest question, right? You did mention about it. They can do certain things, but what are some of the risks with holding at current levels?
So I think this is always a question with any asset class. Whenever you are in a peak of the cycle, that if you book a profit and suddenly market rally, that's the opportunity cost. But broadly, our house view and our CIO also says that next few months might be a little bit challenge on a gold silver price, where price may correct due to a consolidation little bit, maybe geopolitical smoothness or a tariff and a wars might bring some amount of correction. We have seen, I think, 34.95 or 3,500 in dollar terms gold has touched. Currently 33.45 is running. Any correction can be a good way. But broadly, we see that silver might be more resilient, considering the long-term averages. Currently, silver-gold ratio is in favor of silver, if you consider that. But unwinding of premium due to these geopolitical might give some amount of price correction in our view. But yeah, long-term factors support gold. There's a study I think I read where every 50-year gold do the breakouts. So this can be, you can see it's a good jump, hovering around from, let's say, 1,400 to 1,800 was the band, and suddenly it has jumped. So with long term, I think under allocation should look at buying. But yeah, there would be a little bit of correction in our view.
Yeah, you were expecting some bit of a correction, Mr. Shukla, is what you're saying. But this is a different time, right? We've seen that run up coming in right now because of various factors, the geopolitical tension, like you were mentioning as well. But there may be different scenarios when we may see this run up, right? So for an investor, how do you know that this is maybe the tactical opportunity, maybe to book profits, or that structural shift that has come, maybe there is a dip that has come in, this is the time to buy? Are there some points that one could watch out for?
So two things. Time and gold has justified its importance in a place of portfolio with a lowly correlation with, especially with the equity. So in terms of diversification also, aggressive rate cut by Fed, Trump tariff signals may also be more strategic, and tactical shift can be seen. But broadly, at a long-term basis, gold should remain as one of the key feature under asset allocation. And depending on profile, because a lot of people hold gold also in a physical form, considering that, but broadly 7 to 9%, and maybe in case there's an apprehension around the pricing and the correction, maybe SIP can be one good way of building up the portfolio in case it's not there.
Okay, so take that point. So this is how you would look at these precious metals right now. Could be tactical, could be structural, but a lot of questions around this. So in that case, how should investors evaluate different ETF options for precious metal exposure? Physical backed versus futures linked. There's domestic versus international. How would you rate that?
I think easiest is ETF because these are backed by actual gold asset. There are AMC which do physical audit and certification also, including us. So that gives you one benefit. Digital gold one can look at, but I personally feel that SGB was a great option for a retail investor, but now government has stopped issuing fresh one. So ETF gives you a liquidity, surety managed by asset management company. Hence, I think that's the right way of getting into this asset class. Physical has its own challenges of theft, spurious, holding, keeping it in storage and all those things. So there's a best way to buy. Just you need to have a demat, and now non-demat client also can have through wraparound product, which are gold saving product or a fund of fund under which has underlying of gold ETF. At a marginal cost, you get a right pricing as well as a liquidity.
Right. Mr. Shukla, when you're looking at it in terms of past performance, that is what you normally check, right? And it interests everyone because now you have something that's available. The last 1 year, I've gotten so much return in ETFs, whether silver ETFs, gold ETFs, versus something like a large and mid cap that you would compare. Now, how should investors actually look at entering silver ETFs, gold ETFs, or multi-asset allocation also if they're looking at, given that if they want to make that exposure to commodity side, how should they avoid the trap in terms of the past performance, and what are the factors they should look at for silver and gold ETFs?
So gold might see a little bit of correction from whatever current rate, but whenever there is a crisis or a messiness in the market, you will see that gold goes up, right? And we have seen gold rallying from 2000 to 3000, 3300 types, but there can be little bit correction, but there is a chances of touching higher side also. So that is one thing. Second thing, on a silver, a lot of talk are going around that silver will catch up. So there is a Oliver MSA model where it is 2% of gold price. So gold is right now, let's say 3300, 3400 in dollar term, and silver is hovering around 35 to 37, 36. So considering that 2% norm, it should be around 70. So due to these all long-term averages, people are saying that silver will catch up, but definitely not $70 looks like, because see, averages are everything comes to mean reversal. That's true, but if you look at long-term average of gold to silver ratio is around 65 to 70, but if you see last 5-6 years, it is running around 80-83. So yeah, if somebody see from a long-term average ratio wise, silver should catch up that price, but there can be a mean reversal can happen by correction of gold price also. So in my view, the DIY customer can look gold more. Secondly, I think silver has an industrial use also. If you see, gold consumption, holding, storage is approximately 85-86%, whereas 14-15% is industrial use. Contrary to that, silver is 60 to 70% is industrial use now, with all photovoltaic and everything. But when industry will do well, you have another asset class which will capture that rally much better, which is equity, right? So correlation of because of industrial side, gold would be better if you are looking from a asset diversification point of view compared to silver. That's my thought.
Okay, all right. And silver, the clean energy uses basically, right? All of them are driving demand, be it copper, be it silver.
Yeah.
We've been seeing that across precious metal space as well. A very interesting chat, Mr. Shukla, but we have to take a quick break. We'll continue our discussion on the other side on a lot more.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC-TV18 and CNBC-TV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC-TV18 and CNBC-TV18.com.
Welcome back to MF Corner on CNBC TV18. Now, we still have with us Seemant Shukla as well from Quantum AMC. And Mr. Shukla, now we want to put the spotlight on investing in gold and silvers through SIP. What is the possibility over there? How should one actually go about it in investing in these funds? Now, given that, we have seen, like we were talking about, right, silver has been outperforming and multi-asset allocation funds have outperformed versus pure play equity funds in this last few months, especially because of that allocation to silver as well as gold. How should one actually be looking at it in terms of precious metals? And is that rally mainly only because of this precious metals run up? What is your thought right now, first, before we jump into how we should be investing in it?
I think it was due. Gold has been subdued. If you remember 2005-06 in dollar term, it was hovering around 400 to 600 range. Then it moved to 1000 plus 11. I think 11-12 was a time when it rallied to that level. And after that, for an entire decade, it was hovering around 17 to 1800, 1900. So it was overdue. You need some trickle. I think all these geopolitical risk has made a lot of bank has bought, especially non-Western bank has taken a lot of storage side bought gold, which has also, I think there was some news also that it has replaced some second, third currency in terms of storage side. So whenever there is a crisis, gold will do well. Usually precious metal should do well, gold being the core diversified on issue side or wherever there is a crisis. So that way, yeah, you are right that multi-asset allocation funds have has attributed by the rally of these precious metals for sure.
Okay. Now taking forward the point that Vinnii was making, because when we talk about other pure play equity funds as well, the big question is SIP or lump sum. What do you make of it? How effective are systematic investment plans in smoothing out the volatility in these silver and gold funds, say compared to lump sum investing?
So certainly these precious metal has more sentimental and liquidity driven or consumption driven things. Unlike debt or equity, which has their fundamental value in terms of your return on equity, capital allocation, or a debt in yields and everything, these assets might see a larger amount of volatility just because of a sentimental and geopolitical issue, right? Considering that, and SIP always help you to average out and build an optimal asset allocation for a long period of time, doing averaging of rupee cost averaging and everything. So like any other asset class, I'll say if anybody presuming that there will be a high time volatility, gold, silver are no different. So one should go via SIP. If you are currently talking right now to build a portfolio, SIP would be a right way. And I'll say rather than influenced by any big return of recent past, it's safe and better to have asset allocation thought and then allocating via SIP mode. Currently, that's a long-term perspective in my mind.
Okay, SIP is the way to go forward, even whether you're looking at gold or silver in terms of investments in ETFs or funds through that as well. SIP is a route that you're highlighting. Mr. Shukla, how important is overall the allocation coming for these precious metals in terms of my long-term strategy in my portfolio as a mutual fund holding wise? How much should it be in total in terms of a percent? I think you mentioned some 7 to 10%. So in that breakup also, how much should be gold, how much should be in silver ETF, and obviously there'll be some exposure through multi-asset allocation funds as well.
I think if you just draw a heat map of debt, equity, and gold for last 10, 15 years for Indian context only, you will see that gold has been almost equivalent to equity, and because of this last rally, it has done phenomenally well. Considering that ranging, and obviously this as we say, personal finance solutions, person come first, so it has to be a person specific profile and understanding of asset is important. But broadly, earlier it used to be said that 7 to 8% is a good allocation thumb rule model. But we have done also a calculation. We have one solution called 12 BSC, where we said 12 times of your money should be in liquid and 20 into gold and 80 into equities. That yielded a better return than compared to a mix of equity and debt compared to gold and equity has done well. So ranging from 10-12% to 15 to 20% would be a broad good scenario for a gold asset, gold or any precious metal. It acts as a good, excellent diversifier for with a less correlation with the equity. It's also against hedge as a hedge against inflation. At least for Indian market, we can say old people, senior citizen. If you meet somebody, they might tell you that 1 tola of gold or 10 gram of gold will be suffice for your monthly expense. That's a thumb rule of Indian context you can look at. And it stabilizes your overall risk of the portfolio also.
It does. Gold is something that I would say is one of the biggest assets that Indian households have.
I think all our moms are also used to saving those golds, right? Gold ki ginni, but now we have ETFs at least and other ways to invest in gold.
It has a lot of emotional value as well, right? Apart from the investment perspective. So, Mr. Shukla, then, when we talk about market drawdowns, that's where you should increase your SIPs when it comes to pure equity markets. Do you think that is something that goes with precious metals too? The frequency during periods of market correction in gold and silver, should we increase investments in gold and silver then, or a disciplined, consistent approach is more effective?
I think disciplined approach would be more effective because you can't catch the falling knife. You never know what would be the right time. So timing any asset class will be not right thing. Disciplined approach, every asset class, every commodity has their own cycle. You need to see that your portfolio is optimally allocated to each asset, and generating enough return which is expected. Don't just rush for recency bias of return. Best plan is have a disciplined approach, have a proper asset allocation, and start investing. Don't look at timing.
Okay, don't look at timing, just have a disciplined approach is what you are highlighting in terms for silver, ETFs, or even in asset allocation funds or any funds as well. Mr. Shukla, can you talk to us about how important or how different will it be for each investor profile or different goals that everyone may have? How should my allocation change on the basis of that? If I have a different goal, then what should my allocation be to maybe silver and gold ETFs fund versus something like a long term, maybe a retirement plan that I'm going for? Then how should my allocation change? Is there a different way in terms of the percent? You did mention in the starting the percentage that you all follow, but for a long term goal and short term goal, does it have to vary?
Yeah, I think it's important and prudent to have defined goals. So, for example, if you talk about retirement, if you are in an accumulation phase, let's say, which is, let's say, typically 25 or 23, 24 once you get into job, during accumulation phase till, let's say, 48, 50, 52, you need to have a higher allocation to equity. That's a thumb rule, and obviously it will change with each and every person. With consolidation phase, which is when you are nearing or nearby your retirement, you should move into other asset classes also slightly more than equity, or reallocating equity into other like debt. And maybe when you start getting money there, you would love to have, or you should have more of a what do you call, less risky asset, because you have created certain corpus during long term through equity and more volatile asset. And during the dispersal time of your money, you should put money into I'll not say fully debt, but yeah, it's a mix of maybe a multi-asset allocation fund or a balanced advantage fund type of category, where you have a slightly lower risk compared to pure equity.
All right. Okay, Mr. Shukla, it was a pleasure speaking with you today. Thank you so much for joining us and giving us this masterclass. Definitely interesting for those who have or have not invested in precious metals, because usually we talk a lot more about pure equity funds. It was a pleasure speaking with you today.
Thank you.
Okay, all right. With that, we'll take your leave on this edition of MF Corner, but do stay tuned. Closing bell is up next to take you through the last hour of trade.